Welcome back to another federal budget wrap-up. It just seems like yesterday that we were delivering this in October. So what did you think of last night, Alan?
Last night was, for me, another big all about the money spend. To summarise that side of it, the government has said since COVID started have now spent more than $291 billion in trying to inject activity into the economy, which is unprecedented. So it was a lot of money spent, but in a lot of areas that had been crying out for investment for quite some time. So a lot of money spent, but the downside being we're going to pay for it for a while. We're not tipped to return to surplus till 2028, and there's going to be a blowout of debt, nearly $1 trillion before we actually turn the corner. So
lucky debt's cheap.
So let's focus on the big announcements around small business. What was the news last night, Steph?
So company tax rates are going down to 25% on the 1st of July. Now, this is not new. It's not something that was announced in the budget last night, but it is important for people to remember that 1st of July, we get a nice income tax cut for companies down to 25%. It's currently 26%, was 27.5% last year. So overall, not too bad.
So with all that spending, what's in it for small business this time, Steph?
So the first thing wasn't announced last night, it was announced last year, but there is an income tax change for companies. So that rate is dropping to 25%. It is 26% now. It was 27.5% last year. And on the 1st of July this year, we're now going to see that drop down to 25%, which is fantastic for companies. The other interesting thing was the instant asset write-off gets an extension until 30 June 2023. So that's an extra 12 months was announced last night as well. Now, it's really important to remember that this is not a rebate. It's not money back. It literally is a tax deduction for spending on assets such as a piece of equipment that's going to really help your business grow, or, you know, the robot that's going to take away some of that manufacturing. This is what it's actually designed for. I know the media, there are literally things about the utes that will be purchased for people. Sure, if you need a new car, that's great. But at the end of the day, this is designed for investment in equipment and assets that really should be helping your business grow. And it is only a tax deduction. So very important to note that. Only a tax deduction. It is not money back, which means if you're not profitable and you're not paying tax, this really isn't of any benefit to you.
So one good thing, you might be one step closer to a robot.
Potentially one step closer to a robot. For those of you who have these conversations with us, we'd love to name our robot Bruce. So bring on robotics in accounting, we say.
Good to hear. We also heard a bit of talking last night about this loss carryback extension. What's that all about?
So it goes hand in hand with the instant asset write-off. If you purchase a piece of equipment that's $400,000 as an example, chances are you might actually make a loss in this financial year because you can claim that whole $400,000 as a tax deduction, whereas, you know, maybe you were only claiming $10,000 or $40,000 each year before this instant asset write-off was in. So the loss carryback basically allows you to claim your loss against prior year's profit, whereas we normally claim a loss against future year's profit. So effectively, if you made a profit in 2019 as an example, and this current year you made a loss, you'd be able to go back and claim some of the tax that you've paid in 2019 as a refund this year. So quite good, given that we've got this anomaly in how we're claiming deductions, and really the government is trying to boost that spending, so encourage people to do that. Again, this actually is a tax refund of the tax that you've already paid, but we do need to be mindful that obviously next year when you don't have that deduction, you'll be paying some more tax.
Fair enough. Now, one of the big things I was talking about last night, and in that previous budget as well back in October, was trying to move to supporting the digital economy and investing in that and giving businesses incentives to really spend some money in that space and keep Australia innovative in that space. What else happened last night in relation to that?
So the intangible asset tax write-off got a mention last night. It's important to note this doesn't start till the 1st of July 2023. So basically when our instant asset write-off finishes. Intangibles are things like patents or in-house software or licensing. So what happens with those at the moment is you need to write them off over the life of what the ATO prescribes. So for a patent that might be 20 years at the moment, and you literally have to write off the patent over 20 years. On the 1st of July 2023, the ATO are going to make it simpler for everyone, and you can self-assess the effective life of that in-house software or patents. So given the pace of technology is changing and is expected to change more rapidly, it's actually quite good because you can then match the true value of that patent over the years or the true value of the in-house software over the years. So again, it really just does help in streamlining things and making it easier for people. But important to note, it's not coming in for another couple of years. So really not that exciting at the moment.
I also heard something last night though about video games and tax offsets for that.
So fun fact for you, the global video game development market is actually valued at $250 billion. So
huge.
Clearly we need to be doing some more gaming.
Yep.
That was quite a surprise to me.
Sounds fair.
So in order to help stimulate the Australian gaming economy, there is a new 30% tax offset that is going to be introduced for people who are really in that digital gaming economy in Australia. It's not set to start till the 1st of July 2022. There's a huge amount of consultation that will need to be done, and really the only information we have at the moment is you need to be spending more than $500,000 a year in Australia in game development. And important to note, the game can't be anything to do with gambling, so off the list. And that's actually quite a good thing as well. So South Australia has an additional 10% rebate for the actual digital game economy. So the idea is to bring in investment to actually expand our capabilities. And it has good flow-on effects in terms of, defence and AI and everything else for people who are in this game development industry. So hence the government's play to actually do something.
Yeah, step in the right direction.
Yes.
Now, one of the big things, obviously, with COVID, I don't know if it was just us, but I hear it's happened a lot, was the increase in consumption of alcohol. Not condoning it for anyone that's watching. However, there was also some incentives last night for people actually in the brewing and distilling industry.
Yeah, so termed bucks for booze, which I thought was very, very helpful. Effectively, what happens now with small brewers and distillers is they have to pay a tariff. And so at the moment they get $100,000 back, which is up to 60% of that tax that they would need to pay. That is being increased to $350,000.
Nice.
And it is 100% of the tax paid. So that's really going to help people in that you're not going to have to fork out the money and then wait for a refund. Yep. It's a 100% refund. So it doesn't necessarily mean that our gin, we do like to support a lot of small batch distilleries. It doesn't mean that our gin and craft brewery guys are actually going to reduce costs necessarily, but it certainly will make production a little bit easier on the wallet for some of these smaller guys, which is great for good quality gin that we like to sample a lot.
Good to hear. Now, we've also got a focus on some areas of the economy where they're trying to incentivise some more innovation. So last night we had this patent box for the medical research industry.
Yeah, so medical and biotechnologies at the moment. And again, this is kind of something coming in on the 1st of July 2022, but huge amounts of industry consultation. We're trying to, from an economy perspective, keep patents and R&D for medical and biotechnology in Australia. And to incentivise that, the government is now saying that any income you earn from that patent in those two industries would be taxed at 17%, as opposed to the normal company tax rates, depending on your size, of 25 or 30%. So good incentive for people to keep that here, but it's important that it's only the income that you generate from the patent, not from the manufacturing, etc. And the off-the-cuff statement as well, when they're going through this consultation, they're actually going to look at whether clean energy could fit into this patent box, which will keep you updated as more information comes to light.
Excellent.
Now, the fun thing for everyone, employee share schemes. What actually changed in this last night?
Okay, so one of the motives for the government to introduce some concessional taxation around employee share schemes 4 years ago was to try and incentivise more of the smaller scale startups to retain those key staff that are just so important in that building phase of a company. So they went a long way in terms of cutting out the initial upfront taxation with employee share schemes. But some of the way that legislation was written meant that simple things like if the employee ended up leaving meant they got lumped with a massive tax bill at the end of it. So the government's proposed last night to actually remove the cessation of employment taxing point for those share schemes, so that all of the other conditions in each scheme that you're part of would still apply, but it just meant that you're not actually being taxed when you leave the company.
A long way to go in comparison to what people had actually requested was put back into employee share schemes, but I guess it's at least a start.
Yeah, it's a start. But I mean, I think if you think about where the government's going, they're all about jobs, they're all about lowering unemployment and getting everyone back out into the workforce. So if you think about employee share schemes, if you think about the incentives that we've now got to employ and retain and train staff, it's all sort of moving in that same direction.
Yeah. Which is a good segue to our next thing in terms of the apprentice and trainee rebate, which I know so many of our clients absolutely love. There are a lot of those claims we do each quarter. This is now being extended again. So it's important to note that it is 12 months of when you employ a person to kind of their 12-month anniversary. And this is the 50% rebate for that apprentice or trainee's wages, up to a maximum of $7,000 each quarter. So it's the same thing that was announced ages ago. It's just being extended now all the way up to the 31st of March 2022. So basically any apprentice that you decide to employ between now and March, you will then still get the full 12 months of rebate and incentive for them as well, which is fantastic.
And then we've also got the extension and the continuation of job trainer. So
yes.
All of the job keepers, the job makers, we've now got job trainers. So tell us a bit about that.
Well, it's actually designed to bring people back into the workforce again. There are incentives for TAFEs, there are incentives for other educational institutions at the same time. They're trying to get a whole host of other people back into the workforce in different areas. So there are places for women to go into non-traditional women apprenticeship and traineeship things. And so we'll see a lot of spending on training in total over the next few years.
Good. I think maybe now's a good time just to summarise some of those big areas where the government's just dropping the cash like no one's business.
Yeah, so, there's so much money that is being spent at the moment, $17.7 billion for aged care, another $15 billion to our already $100 billion infrastructure plan over the next 10 years, $1.7 billion for childcare, $4 billion for some of those training programs we just talked about, $2 billion in what they're classing as kind of this patent box and a few other things around the surfaces for R&D, not R&D tax incentive, very important to understand that. Then $1.2 billion for the digital economy strategy. So in relation to some of this funding, that's where certainly small businesses are going to be able to have a look at what funding is available to them. There obviously, as there always is on budget night, a whole host of missing pieces of the puzzle. So we know that there is money being spent, but not necessarily where. I guess the most exciting part for me, for small businesses, was the deregulation package, where they're trying to make it easier to employ people. Now, I don't know any person at all who actually enjoys having to deal with awards and pay rates and what they should be doing for employees. It is definitely a nightmare. So as part of this deregulation package, the government is working on being able to open up their API to effectively Fair Work, and they want to work with software suppliers so that it can all be inbuilt into our actual software program. So that's quite exciting. Obviously, it will take a little while for that to roll out, but will definitely be helpful The other thing of note is I don't know anyone who likes dealing with any government agencies, the MyGovs of the world. It's just tedious as a business owner. So there's a lot of money being spent in that area to hopefully make it easier as well.
Yeah, certainly will for us accountants and trying to help our business owners explain where their taxes and other things are up to.
So we'll be posting over the next few days as well as more information comes out on each of those packages. But let's now turn our attention to our normal part, which we say is SMSFs. But at the end of the day, there didn't seem to be much at all for SMSFs.
Yeah, nothing really specific in that space other than for people who were maybe travelling overseas and temporarily leaving Australia. There used to be a 2-year limit around that if you weren't back, you had to release that management and control to someone else, which generally meant bringing in another member or surrendering that self-managed super fund and converting it to another industry-style fund. The proposal last night was that would be increasing to 5 years. So people that sit in that space, it's certainly beneficial for them because it's less onerous on them to now have to deal with their super if they are going overseas and for whatever reason, like being trapped in another country because of COVID, not going to cause them too many grief options this year.
But there are quite a few changes with super in general. Yeah. So let's start with the super guarantee rate change.
Yeah, so it's always been, since the superannuation guarantee started, the plan was to increase the rate at which we save as a country for our own retirement. So the plan was always to go up to 12%. Originally it was up to 15% of our actual salaries going into superannuation. But along the way that obviously got stopped by governments and what have you. The government has actually agreed bipartisan agreement there that would be increasing that now back up to 12% by 2026. So from the 1st of July this year, it's going up to 10%, and then every year thereafter, we're going up 0.5% until we reach that full 12%.
So really important for employers, especially if you have given employees a contract that is plus super.
Yes.
So wage plus super, because you'll be paying an extra 0.5% on that employee's wage with that additional super come the 1st of July.
Yeah, that's right.
All right, what happened with this nice thing called the works test at the moment for people who are, let's say, nearing retirement or at retirement age?
Yeah, you used to have to do this silly thing, which was basically work a full week in a month to be able to make a contribution after you reach the age of 65. The government's trying to release and relax the rules around that. So they're basically trying to remove that works requirement up to the age of 74. There's just one more hurdle in that step to go, and for people that want to make concessional personal contributions, that works test still is required, but we're moving in the right direction in that space.
So what you're saying is when I get to the 65 age, I don't have to work as many hours and I can still have my employer contribute to super.
That's exactly right. That's what I want.
Now, what about downsizer contributions? There was another announcement made in relation to that.
Yeah. So obviously, if you think about Australians and where their wealth sits, and particularly from the baby boomer generation, it's basically your family home. And if you're lucky enough to pay that off early enough, you might have some money in super. But as we all get older and, house prices go up and people want to downsize and simplify their life, the announcement a couple of years ago to introduce this downsizer contribution was a great initiative for people that literally are selling a couple $1 million home and buying having a spare $1 million cash maybe, or maybe not quite that much, but putting some of that into superannuation to fund your own retirement. So it actually really made a lot of sense. The conditions around that originally were you had to be at least age 65 to be able to do that. So last night's announcement meant we're actually going to reduce that down to age 60. So if you're doing that planning lead up to that retirement, you want to start that downsizing process earlier, it's going to be a lot easier to do that now.
Fantastic. We've also scrapped the $450 monthly threshold amount, but again, important that this doesn't start till the 1st of July 2022.
Yeah, look, and that helps people that are working part-time, because sometimes, if you're working casually, you didn't have a lot of shifts in that month, you might not reach that $450 threshold, and particularly if you listen to all of the commentary, that affected women in particular. So that requirement to earn that $450 a month is going to be removed for everyone, with the main beneficiaries being women, but it's just another technicality that's being removed, which just makes it a lot more simple to be able to administer super.
Yeah, and a lot easier for employers who had to actually say to someone, super's not calculated until you actually earn $450 in the month to start with. And so, yeah. Now, what's happening with the super contributions increase?
Yeah, so when the government announced these caps, so the $25,000 concessional, which is the tax deductible ones, and the $100,000 non-tax deductible. The initiative was always to index that over time, so that the real cost of that was keeping pace with inflation. So because of the time that's elapsed since that first came in, that's now increasing. So it's now going to be $27,500 for those tax deductible contributions and $110,000 for the non-tax deductible contributions. So as these superannuation things release and increase, we're going to be looking at even more money going into that superannuation sphere.
And we've got this nice thing where at the moment we can bring forward anything that we haven't used in our cap. If, say, for the last 3 years, I've only contributed $10,000 a year to super and my contributions cap was 25, and let's say this year I've done really well and I've got a whole host of profit and I've got some good cash flow and I want to put the whole $27,500 in, I can put more in as well, right?
Absolutely. So that was another good initiative a couple of years ago for making people be able to top up their superannuation when they can. So matching the timing with the contribution limits has always been important. But if you think about businesses in particular, where the owners of the business, who are typically the people that don't pay themselves well for superannuation, are in a position where you can go back and claw back up to those previous cap limits of the 25,000s for the amounts you didn't put in for the last 3 years, which means if you're having a really, really good year, you could put, upwards of $50,000 or $60,000 into superannuation, which a lot of people are doing in that self-managed super space, because if you're looking at the potential to buy a business premise where you might operate your business from, and you're able to put that money into super, then if you're doing that with a self-managed super fund, that can be a really powerful tool to take control of that superannuation money and put it to work for you.
Perfect. And the last super thing that was really announced is the First Home Buyer Super Saver Scheme. Try to say that fast without using the acronym.
Yeah. So that's two big problems. So one of them is superannuation and getting people interested in it and taking control of it. But it was also the effect that people struggle to pay and buy their first home. So the incentive previously was you could save and voluntarily contribute up to $15,000 a year into this First Home Saver account, up to a maximum of $30,000. The government's increasing that limit now to $50,000, which is very helpful for first home owners.
Perfect. And that's really it for super.
Yep.
That was announced this year. And it's quite funny. I think everything was leaked this year. There didn't seem to be anything that was brand new last night. It's all been drip fed over the last few weeks.
So maybe now's a good opportunity to recap for individuals what that means tax-wise.
Yeah, so personal income tax cuts aren't coming this year. They actually were brought forward into last year. So no changes to the personal income tax cuts for this year. One of my favourite little acronyms or media things that are out there is Lamington, which is the low and middle income owners tax offset, not the actual Lamington that you would like to eat. So that was introduced. It's been there last year in terms of the $1,080 for singles, depending on where you're sitting in terms of your income. That's been extended again for this year. So effectively for individuals, nothing is changing than what it did last year, except for a slight increase in some of the actual Medicare levy rates of where you end up needing to start to pay Medicare levy, but they're very, very slight, so hardly any changes there. Something to note, which is not really that exciting, self-education costs if you paid for a course or something that has a direct connection to your job, to your current job, not for improving what you're currently doing, you can claim that as a tax deduction. Ordinarily, you can't claim the first $250 of that. You just claim the rest. They've scrapped that. So again, something to make life easier for people. There's a change to the residency rules. This again is a quite complex piece of legislation. I'm not sure it's as relevant now that no one can go anywhere. But when we can again, the residency rules will be simplified to say if you spend 183 days in the country, then you are definitely an Australian tax resident, and then we'll apply the other rules post that. So very good to clear that up, which is quite helpful. And the other thing is not really individual tax, but there are changes to some of the childcare subsidy rules coming in for people who've got 2 young children in care. So that will be quite good from a childcare subsidy perspective as well.
Yeah, and we'll summarise that in our blog posts coming out shortly.
Definitely. So there really wasn't anything that was, I guess, super exciting or is rapidly going to change anything for people to action right now. There will definitely be some money that we need to be looking at in terms of, what grants can people be applying for? Are there other things in certainly the digital stimulation package that small businesses can grab a hold of? But for the rest of it, we actually knew most of it.
Yeah, we did.
Which is a good thing. It's fantastic to be able to pre-plan now, though, that for things like the instant asset write-off, if you were, trying desperately to bring forward a purchase into the 2022 year and maybe cash flow was going to be a bit tight, it's great to know that we can do that for the 2023 year as well.
Yep, great. All right, was there anything else major last night that we need to cover today? Or?
Nothing major at all.
Okay. Easy then. Well, we'll be summarising all of the announcements in another blog post that's coming out to all of our subscribers later on today. And we're also doing a Q&A style session this afternoon at 5 o'clock. So if you check out our Facebook page and have a look, there's a link to join that via a Zoom link. Suggest that you get on there and register for it. And for those of you that do, we'll see you at 5 o'clock this afternoon.
For a live Q&A, which is always fun. We can't wait for the questions.